Welcome to KingTrade's introduction to a very exciting product called Premium Securities. This video will give you a good understanding of premium securities, what they are, how to use them, and their many benefits to your trading and investing. We will also present real-life trading examples using premium securities on our powerful and intuitive trading software. Our main goal will be to outline how you can minimize your risk and maximize your profits for better trading and investing performance through premium securities. A premium security is a fixed investment that gives you a leveraged exposure to a choice of thousands of financial trading products worldwide from one account, all with limited financial risk to the trader or investor. Premium securities have embedded leverage, which means you have the potential of making higher profits or losses when compared to trading the more traditional cash value of the underlying financial instrument. However, these potential losses are limited to your investment amount. They can be traded on US and UK stocks, ETFs, currencies or FX, commodities and indices with one click, 24 hours a day, all with limited financial risk. One of the key advantages of a premium security is that you can leverage your investment. However, unlike margin trading, where you can lose more than your required margin, with a premium security, your losses are limited to your investment amount. You cannot lose more money than you have invested because a premium security comes with a built-in guarantee that you will never lose more than your investment amount. It does not matter how volatile the market you are trading is. If your investment loss is executed, you get that price or better 100% of the time, guaranteed. Premium securities eliminate the need to get the timing of your investment exact because you have no time limit on your investments. You can hold your leveraged exposure as long as you wish, provided the market has not moved to your maximum loss level. There is little difference from trading with a premium security to the CFD and FX products we already offer, other than the leverage amounts are higher for premium securities because they come with a built-in guarantee. Premium securities are priced almost identically to their underlying financial market. The pricing of profits or losses are quoted in real time and are based entirely on the price movements of the underlying market. If the price of your investment moves $1 in your favor, you make $1 per share that you have invested, but you are never liable for any losses greater than your investment amount. This is the power of having a leveraged exposure with limited financial risk. You can go long or short with one click on thousands of trading and investment products worldwide from one account. There are no restrictions on short selling, so you can profit from price declines. You can go short just as easily as going long. A premium security has similar properties to buying an option. Your losses are limited to your investment amount and your potential for profits are virtually unlimited. However, premium securities do not have an expiry date and you can choose when to sell your investment. You can never lose more money than you invested. Even if a stock or market gaps far beyond your maximum investment loss, you will still never lose more than your investment amount because your investment is guaranteed 100% of the time. Since premium securities are leveraged products, you only need a fraction of the total notional value of the trade. One of the most powerful aspects of a premium security is when you wish to take a profit on your investment. You never have to sell a portion of your investment to take a profit. As the value of your investment rises, you can take portions of that investment out and not reduce the size of your position. This means that you can continue to benefit from the full leverage position of your investment and still put profits in the bank. This product was truly designed keeping the old Wall Street saying in mind, let your profits run and cut your losses quickly. This is an example table of a few different products showing how much you would have to invest to gain a leveraged exposure to the specified quantity. Keep in mind the investment amounts would be the same if you were short selling instead of buying. You can invest larger or smaller amounts if you wish. These numbers are just to give you an idea of how your investments can work for you with the powerful leverage that is built into a premium security. Our leverage amounts for CFDs are amongst the best in the CFD industry. We offer 100 times leverage on indices, FX, and bullion, 33 times on commodities, and 20 times on stocks and ETFs. Think of it as you only need $1 to gain $100 exposure worth of indices, FX, and bullion, $1 to gain $33 exposure worth of commodities, and $1 to gain $20 exposure worth of stocks and ETFs. With premium securities, we are now able to offer even better leverage amounts. We can do this because we have built in a guaranteed investment loss so that you can sleep at night and not have to worry about big news events that can sometimes cause large losses. We now have doubled the leverage to 200 times on indices, FX, and bullion, more than doubled the leverage on commodities to 70 times, while stocks and ETFs remain the same at 20 times. You can now think of it as you only need $1 to gain $200 exposure worth of indices, FX, and bullion, $1 to gain $70 exposure worth of commodities, and $1 to gain $20 exposure worth of stocks and ETFs. We don't recommend that you use this extra leverage, but it's there in the event that you need to or wish to. Keep in mind that you can reduce the leverage on premium securities, and we will show you how to do this later in this video. These new leverage rates offer traders new and exciting opportunities to create dynamic trading strategies. However, please keep in mind that although leverage can create profits faster, it can also create losses quicker. But with a premium security, your losses are and always limited to your investment amount and are guaranteed. In addition to your investment level, premium securities also create a stop-loss order that is automatically placed in the market for you. The stop-loss order is there for normal market conditions and will be executed at a price that is less than your investment amount. The full investment loss level is there to protect you in case of a large gap against your position. We'll talk more about this a bit later. The first thing you need to do when calculating your stop-loss level is to calculate your investment amount. You determine this by taking the share value of the stock, ETF, or commodity you are trading, multiply that by the number of shares or units, and divide it by the leverage amount for the product type you are trading. Keep in mind that if you are trading FX, then replace shares with dollar amount. This table is just a set of random examples. You can buy or sell more or less quantity if you choose to. However, different quantities will change the amount of the investment. In order to calculate the stop loss, you will also need to know the stop loss percent for each individual product. These are the current stop loss percentages that are used in the stop loss calculation. Different markets will have different volatility characteristics of how they gap, and these percents are designed to accommodate those gapping characteristics. For example, stocks will tend to gap almost every day, but currency markets are traded 24 hours a day and will only ever gap on Sunday night under normal circumstances. The stop loss amount is calculated by taking the investment amount and then multiplying it by the stop loss percent. If you want to calculate the loss per share, you simply take your stop loss amount and divide it by the number of shares you have purchased for your investment. This will give you your per share loss that will be executed under normal market conditions. Here's a table that shows a few examples of different products and how the stop loss percent affects the stop loss levels. The reason these calculations are not equal to 100% of the investment amount is because we build in an extra insurance policy for you in the event that the product you are holding your investment gaps significantly against your position. That insurance policy is the difference between the stop loss level and the investment loss level. This does not mean that you will lose 100% of your investment every time. In fact, under normal market conditions, you will lose far less than your investment amount. We like to think of it as having an insurance policy that you only ever have to pay for in the event that you need to use it. Just imagine if your car insurance was like that. Let's take a look at a couple of examples of how stop loss and investment amounts are calculated on real trade examples using the power of a premium security. Keep in mind that although we have chosen to use a 60-minute chart for our trading decisions, you can use any time frame you want to. Premium securities work equally well with all types of traders, from the scalp and day trader all the way to the long-term investor. The key is that you limit your losses with a guaranteed investment loss, but still have all the upside profit potential. A trader has decided that he likes the bullish price action taking place on Cisco Systems stock that is listed on the NASDAQ. He decides to buy 1,000 premium security shares at a price of $24 per share because of a nice gap higher on November 5th. The market trades bullishly over the next few days, and the trader holds tight, believing that the market is getting ready for another big push higher. The trader has the confidence to hold because he is covered if something goes wrong by having a guaranteed investment. If the trader was buying these 1,000 shares of Cisco Systems on the open market, it would have normally cost $24,000 to purchase. With a premium security, the trader would only need an investment of $1,200 to gain the same leverage exposure to 1,000 shares at $24 per share. When you buy a premium security, it comes with a built-in stop loss that is automatically placed in the market. In this case, your stop loss would have automatically been placed at $23.16. In the event that there was a gap against your position, your investment would be closed at a price of $22.80, provided the gap was beyond your stop loss price and exceeded your investment amount. This is the insurance that is built in to protect you from greater losses than your investment amount. A few days later, Cisco reports its quarterly earnings after the close of trading. The results are disappointing and the stock gaps dramatically lower to $20.35 per share the next morning. If you were trading with traditional cash value shares, the best price you could have closed out your position after the gap would have been around $20.35, for an approximate loss of $3,650. This would have represented a loss of over 15% in just a few days. If you were trading on margin, the loss percentage would have been much higher. However, with a premium security, your maximum loss was never more than the full value of your investment, which was $1,200. In this case, by trading with a premium security, you would have saved yourself approximately $2,450. This is a real trade example on one of the largest technology companies in the world. Having an investment in premium security can allow you for a better night's sleep knowing that you are protected in case of extreme situations like this. However, keep in mind that if Cisco Systems moved higher, as this trader anticipated, he would have reaped the full rewards of having a leveraged exposure to 1,000 shares. This gives you unlimited upside potential and limited downside risk. Now let's take a look at how we calculated the stop loss and investment levels for this investment in Cisco. Start by taking the share purchase value of $24 per share and multiplying it by the 1,000 shares. You then divide this number by the leverage factor of 20, and this gives you an investment amount of $1,200. This investment amount of $1,200 is the absolute maximum that you have at risk in this investment. If you would like to calculate what the investment loss per share is, you would take the investment amount and divide it by the number of shares that you are exposed to. In this case, you would take your investment of $1,200 and divide it by 1,000 shares, giving you a loss of $1.20 per share. To calculate your stop loss level, start by taking your investment of $1,200, then multiplying it by the stop loss percent for stocks, which is 70%. You will get a dollar value of $840. This dollar value represents your stop loss level that will close your investment under normal market conditions. If you would like to calculate what the stop loss per share is, you would start by taking the stop loss amount and divide it by the number of shares that you are exposed to. In this case, you would take your stop loss amount of $840 and divide it by 1,000 shares, giving you a loss of 84 cents per share. The difference between the investment loss and the stop loss is the insurance that is built into the investment to protect you in the event of a big gap against your position. Keep in mind that under normal market conditions, you only would lose $840, not the full investment of $1,200. The difference between the stop loss and the investment loss is a small price to pay in a situation like this Cisco example. We are sure that any trader would be more than happy to pay this insurance to save themselves $2,450. Remember, you only ever have to pay for the insurance in the event that you need it. This is an extremely powerful advantage for traders and investors.